Back in 1999, when an IPO popped, like 65% on its opening day, the financial media just celebrated it as this massive win for everyday investors.
Oh, yeah. It was the headline everywhere.
Right. But today, we know it was actually the ultimate insider trap. So welcome to the deep dive.
Glad to be here.
Yeah, and before we unpack how today's private equity firms and, venture capitalists are essentially running the exact same playbook, we do have a quick community update.
Right, the housekeeping stuff.
Exactly. So to access more advanced researches, applications, and our latest published personal intelligent multi-agent deep value intelligence, welcome to explore and join deepvalues.ai community. And also, to track total market temperature, welcome to search and download iOS app Buffett Indicator from Apple App Store.
Yeah, and I'll just jump in here with a quick reminder for you all. All analysis is based on publicly available sources and may be subject to revisions or differing interpretations. All contents from this channel is for information and research purposes only and does not constitute investment advice. Conduct your own due diligence before making investment decisions.
Perfect. And if you like to access wider topics, including life and investing philosophy, please subscribe to our sister channel, Deep Values. Don't forget to like this video. Much appreciated.
Always appreciated.
All right, let's look at the mission for today's deep dive because we have a pretty heavy stack of sources.
We really do.
Yeah, we're pulling from this comprehensive century-long report on IPO cycles and market tops. We're also looking at a real-time, weekly market indicators dashboard.
Which is fascinating right now.
It is. And to ground all of this in the current macro environment, we are parsing a transcript of the weekly wrap from financial analyst Steve Eisman, and this was recorded on May 21st, 2026.
Right. And really, our objective here is to synthesize these three distinct pillars for you.
Yeah, exactly.
Because, we have these structural metrics that are just flashing extreme overvaluation on one side and then a rapidly deteriorating retail consumer on the other.
Which is such a crazy disconnect.
It is. And we're going to use the historical mechanics of IPO markets to sort of connect those dots. By the end of this discussion, we want you to really understand the underlying temperature of this market.
Right. And more importantly, the specific microsignals that tell you when a speculative bubble is quietly being, unloaded onto the public.
Exactly. Unloaded is the perfect word.
So taking the current temperature right now, it reveals a pretty terrifying contradiction between Wall Street and Main Street. Let's just look at the weekly market indicators dashboard.
Yeah, let's start there.
The Buffett indicator, and for those following at home, this tracks total U.S. equity value relative to GDP. It has an alert threshold of 210%.
Which is already high.
Right. But today, it's sitting between 221 and 227%. It's totally tricky.
Yeah, that's massive.
And we are also looking at the Schiller Cape E index, so the cyclically adjusted price to earnings. And it's floating around 40.9 to 41.7.
Wow.
Anything over 40 puts us in the rarefied air of the late 90s .com extremes.
Yeah, it does. And when metrics like Cape E cross that 40 threshold, it essentially signals that the market is pricing in absolute unblemished perfection for the next decade.
Perfection.
Right. And the implied long-term valuation risk there is just enormous because any slight deviation from perfect growth fundamentally breaks the math of those multiples.
Well, okay, I am going to push back on that historical comparison, though.
Oh, go for it.
Let's play devil's advocate for a second, using Steve Eisman's own data. If we look under the hood at actual corporate performance, these companies are kind of delivering on that perfection.
You're talking about the recent earnings?
Yeah. Eisman notes the Q1 S&P 500 earnings growth was expected to be around 14.4%. The actual print came in at an incredible 28.3%.
It's a massive beat, yeah.
And we have to talk about the AI structural shift. Look at NVIDIA. They grew their revenue by 85%. Their EPS shot up 95%, and they're doing it with 75% gross margins.
Those numbers are staggering.
Right. So if the biggest companies on the planet are literally doubling their earnings, why shouldn't we just ignore a historical metric like a CAPE of 40? Like maybe the 210% Buffett indicator threshold is just obsolete in an AI-driven economy.
Well, you just use the most dangerous 4 words in finance.
Oh boy, this time is different.
Exactly, this time is different. Look, the explosive growth of a company like NVIDIA is undeniable, right? But corporate earnings don't just exist in a vacuum.
Sure.
Valuations are ultimately anchored by the cost of capital. You can have a company doubling its earnings, but if the macro environment shifts, specifically interest rates and consumer liquidity, well, those earnings are suddenly worth less to an investor.
I see what you're saying.
Yeah, and Eisman points out that the 10-year Treasury yield recently hit 4.6%. He actually calls a 4.5% yield the Rubicon.
Meaning, once you cross it, The gravitational pull on equities just becomes too strong.
Exactly. When the risk-free rate is offering nearly 5%, the present value of future cash flows, which, is how these high-flying tech stocks are valued, it gets mechanically crushed.
Because investors demand a higher risk premium.
Right. And while the enterprise side is out there buying AI chips hand over fist, the bedrock of the economy, the retail consumer, is showing severe exhaustion.
Oh, man. Yeah, Eisman's data on the retail side is grim.
It's pretty bleak.
Target managed a 5.6% bump in same-store sales, but then management immediately threw cold water on it. They warned of a severe tightening ahead.
Yeah, they were not optimistic.
Not at all. And Walmart entirely missed their earnings guidance for the next quarter. They're projecting 72 to 74 cents against a 75-cent expectation.
Which is a big tell.
Yeah. And then you look at housing and home improvement. Home Depot and Lowe's both basically flatlined with an anemic 0.6% same-store sales growth.
And the underlying mechanics of that weakness are what really matter here. Both Target and Walmart explicitly cited the fading stimulus of tax refunds and the really aggressive bite of higher oil prices.
Yeah, just the everyday cost.
Exactly. This is a massive liquidity drain. Consumers are spending a larger percentage of their disposable income just to commute and keep the lights on.
Which leaves a lot less for discretionary spending.
Precisely.
And Eisman actually ties those rising oil prices directly to geopolitical catalysts.
He does, yeah.
He specifically mentions former President Trump threatening to start bombing again as a rhetorical driver that spiked oil markets.
Right.
And just as a quick reminder for you listening, we are strictly parsing Eisman's market view here, just to understand the mechanics of oil prices.
Yeah.
We aren't taking any political sides or endorsing the politics behind it at all.
No, absolutely not. We're just looking at the input costs, right? So if you synthesize that whole setup, you have a market commanding dot-com era multiples colliding with a risk-free rate that has crossed the 4.5% Rubicon and a consumer base that is completely tapped out.
So the margin of safety is effectively zero.
It's zero.
Which, well, that brings us to a really dark logical pivot.
Right.
If the macro setup is this fragile, why are we seeing so many companies rushing to go public? I mean, that is where this century-long IPO report pulls back the curtain on human behavior. Because when public market valuations hit these irrational highs, the insiders, so the founders, the private equity firms, the VCs, they see a massive arbitrage opportunity.
Yeah, it's formally known in the literature as the market timing hypothesis.
Okay.
These insiders have perfect asymmetric information.
Meaning they know more than we do.
Exactly. They know the exact intrinsic value of their company. They know its flaws. They know its decelerating growth metrics long before the public does.
Oh, wow.
So when they see retail investors eagerly paying 40 times earnings, they recognize a rapidly closing window.
They know it's not going to last.
Right. They list their shares when the public's fear of missing out is just blinding them to the fundamentals.
Because the cost of capital is effectively zero when the public is just, throwing money at them.
Exactly.
And the report proves this isn't some new phenomenon invented by Silicon Valley either.
No, it goes way back.
Right, let's go back to 1929. The popular history just focuses on the October crash. But it was preceded by an absolute frenzy in what were called investment trusts.
Oh, yeah, those were wild.
Yeah, they were essentially unregulated, highly leveraged mutual funds. By August 1929, they made up 60% of all new market issuances.
That's just staggering. And the mechanics of those trusts were designed purely to extract fees from retail speculators.
Absolutely.
But the real signal was what the insiders were doing at the time.
Yes. This was the most fascinating data point in the entire report for me.
The seat prices.
Yeah. If you want to know what the smart money was thinking in 1929, look at the price of a seat on the New York Stock Exchange. A seat gave you the right to trade on the floor and collect volume fees, right? In the months prior to the October crash, while the Dow Jones was still printing record highs, the price to buy a seat dropped by 20%.
It's such an incredible leading indicator.
It is. The insiders on the floor were quietly pricing in a catastrophic collapse in trading volume and asset values, even while they were out there selling those investment trusts to the public.
It's ruthless. And we saw the exact same distribution phase in the 1999 and 2000 dot-com bubble, just dressed up in different technology.
Right, pets.com instead of investment trusts.
Exactly. That famous IPO pop averaged 65% on the first day of trading.
Which people thought was a good thing.
Right, but from a corporate finance perspective, if a company's stock pops 65% on day one, the underwriters fundamentally mispriced the offering.
Yeah, they left billions of dollars of capital on the table that could have gone straight to the company's balance sheet.
But look, the underwriters aren't stupid.
Yeah.
That underpricing wasn't an accident, it was a deliberate marketing expense.
Oh, that's such a good way to put it.
By artificially keeping the initial offering price low, they guarantee a massive first-day headline.
Right.
That 65% pop acts as a siren song, just luring in retail momentum traders who assume the stock will just keep going up forever.
And meanwhile, the quality of what was actually being sold was deteriorating rapidly.
Fast.
The data shows that in the 1980s, only about 20% of companies going public were unprofitable.
Yeah.
But by the peak of 1999 and 2000, nearly 80% of them were bleeding cash.
It completely inverted.
It did. And, we lived through the modern rhyme of this in 2020 and 2021 with the SPAC boom.
Special purpose acquisition companies.
Yeah, these were literally blank check companies raising billions based on pre-revenue PowerPoint presentations about, like, space mining and electric vehicles.
That's pure euphoria.
Yeah. In 2021, 613 SPACs raised $145 billion.
Wow.
And when the Federal Reserve finally ended the zero interest rate party, the D-SPAC index lost 70% of its value. The insiders got their management fees, and the retail investors basically held the bag.
Which the report frames through the lens of auction theory, specifically a concept called the winner's curse.
Okay, let's contextualize that for the listener.
Yeah.
The winner's curse essentially means that if you win an auction where the true value of the item is highly uncertain, you almost certainly overpaid.
Right.
Why? Because you had the most optimistic and therefore the most statistically flawed valuation in the entire room.
You're the one who got it wrong the most, basically.
Exactly. Trying to get an allocation of a hot IPO as a retail investor is like, well, it's like trying to get a table at an incredibly exclusive Michelin star restaurant on a Friday night.
Okay, I like this analogy.
If you call them up and they happily give you a prime 7 p.m. reservation with zero hassle, you shouldn't feel lucky.
You should be suspicious.
Highly suspicious. The food quality is probably tanked. If the institutional smart money actually wanted that IPO allocation, they would have taken it all.
Oh, absolutely.
The fact that the syndicate desk is letting you, the retail investor, buy it
Right.
just means the informed money passed on it.
And that structural reality is exactly why an IPO boom is such a reliable indicator of a market top.
Right.
If it is easy for the uninformed crowd to buy, it's because the informed crowd is enthusiastically distributed.
Unloading.
Right. And we have to address the glaring anomaly in this data set.
Oh, I know where you're going with this.
If extreme public issuance signals a top, how do we model the 2008 Great Financial Crisis?
Yes. This is where I really wanted to test the limits of this indicator, because the market peaked in 2007 and completely unraveled in 2008. But if you look at the data, there was no massive equity IPO boom leading up to it.
There wasn't.
So does that break the market timing hypothesis entirely?
It doesn't break the hypothesis. It just demands that we look at a different asset class. 2008 was a credit and housing bubble, right? It was not a public equity bubble.
That's true.
The extreme unhinged issuance wasn't happening on the New York Stock Exchange. It was happening in the fixed income markets.
Through securitized debt.
Exactly.
Yeah.
Mortgage-backed securities and collateralized debt obligations.
In fact, the equity markets were experiencing the exact opposite of an IPO boom then.
Right.
Public companies were actually shrinking in number because private equity firms were taking them private through massive leveraged buyouts.
Yeah. So the hot issuance was in the bond market. And this brings us right back to the present moment, to a highly relevant segment from Steve Eisman's mailbag.
Oh, this part was so good.
It really was. An analyst from Fish Ratings wrote to him about the current state of private credit and private equity, and the parallels to the pre-2008 hidden leverage are deeply concerning.
Yeah, Eisman laid out this brilliant deduction regarding private software companies. He pointed out that public software giants are currently taking an absolute beating because the market is trying to price in AI disruption, right?
Like, Salesforce is down 35% year to date. ServiceNow is down 50% over the past year. Eisman's logic here is just undeniable. If the massive, highly profitable, transparent public software companies have lost half their value, then the mediocre, opaque software companies that private equity bought up with heavy debt 3 years ago must be down at least 50% too.
Oh, absolutely. But because those companies are private, they don't have to mark their assets to market every day.
They can just hide the bleeding.
They can hide it, but they can't hide it forever.
No.
And this introduces what the credit markets call the refinancing wall.
Right.
Those private equity-backed companies were purchased using debt that matures between 2027 and 2031.
And here's the mechanical problem.
Yeah.
They bought those companies when debt was essentially free. Now they have to refinance in a world where the 10-year Treasury has crossed that 4.6% Rubicon we talked about earlier.
Exactly. Think about the interest coverage ratios.
Mhm.
If a private equity firm bought a tech company at 15 times EBITDA with 70% debt at a 4% interest rate.
The cash flow works fine. Right, it works. But when they have to roll that exact same debt at, say, 9%,
Oh, wow.
the interest expense just wipes out all the free cash flow. The math simply breaks
It's unsustainable.
completely.
Right.
When they go to refinance, the private credit lenders are going to look at these software companies, see their valuations have been cut in half, and demand that the PE firms inject fresh equity just to cure the covenants.
And if the PE firms refuse to throw good money after bad, I mean, they will literally have to hand the keys of the companies over to the private credit lenders.
Yeah.
So the lack of a massive equity IPO boom right now shouldn't really make anyone comfortable. The bubble just migrated. It's sitting in private credit, much like it was sitting in mortgage bonds in 2007.
That's the scary part. So how do you actually survive this setup?
Yeah, let's talk strategy.
We've established the macro vulnerabilities,
Mhm.
the high KPI ratio, the tapped out consumer, the rising cost of capital.
Right.
And we've established the historical reality of insiders selling at the top. So we need to look at the specific microsignals that allow you to actually navigate this.
Okay, the first microsignal the report highlights is the gray market premium, or GMP.
A really important one.
Yeah. For those unfamiliar, the gray market essentially functions as an unofficial futures market, where institutional investors trade the rights to an IPO's shares before it officially lists on an exchange.
It is a direct quantifiable measurement of retail FOMO.
Yes.
If you see a highly anticipated tech IPO commanding a gray market premium of 50% or even 100% over its intended issue price.
It's priced for absolute perfection before a single official trade is even executed.
Exactly. Our data indicates that extreme GMP is a classic signal of a local market top.
Right.
It reliably predicts that massive short-term pop on day one, followed almost inevitably by a brutal multi-year flop, as the fundamentals just fail to catch up to the hype.
And speaking of the flop, the single most important mechanic to watch is the lockup expiration.
Oh, this is huge.
Right. When a company goes public, the insiders, the founders, and the VCs are legally restricted from selling their shares for a set period. Usually, it's 90 to 180 days.
Right, and this artificially constrains the public float.
Yeah,
It's kind of like a cartel restricting the supply of oil to keep the price elevated.
exactly. It's an artificial supply squeeze. But the day that lockup expires, the available supply of tradable shares can triple or quadruple overnight.
It's a flood.
It's like a dam bursting on supply. And if you watch the tape on lockup expiration day and you see insiders aggressively hitting the bid to dump their shares, the literal second they're legally allowed to.
It's the ultimate red flag.
It's the ultimate bearish divergence. They are loudly telling you through their actions that they do not believe their own company can sustain its public valuation.
Right, they are rushing for the exits. Which, brings to mind another fantastic detail from Eisman's mailbag regarding the famous trade immortalized in The Big Short.
Oh, I love this part. Yeah, a listener asked Eisman about that incredibly dramatic movie scene where Steve Carell, who plays a fictionalized version of Eisman, is agonizing on a rooftop in Manhattan before finally screaming into his cell phone, "Sell it all!"
It's a great cinematic moment, but Hollywood requires catharsis, right? High finance rarely operates like that.
No. Eisman explained that the real exit was almost eerily quiet.
Yeah.
In the spring of 2008, his fund started to model out the political risk. They realized that if the government stepped in and orchestrated a massive bailout to guarantee the toxic debt, well, their credit default swaps might not trigger, or their counterparties might be shielded.
Right, the systemic risk of winning the trade.
Exactly. So there was no screaming on a roof. They simply picked up the phone, quietly called the trading desks at Goldman Sachs and Deutsche Bank, asked for prices to cover their short positions, accepted the bid, and quietly walked away with their profits before the crowd even understood the systemic risk.
That's it. The smart money does not panic. They look at the structural mechanics of the market, they evaluate the counterparty risk, and they take action quietly. So if we distill this century-long IPO report down to an ultimate actionable strategy for you, it is simply this. Avoid the pop. Wait for the flop.
Avoid the pop. Wait for the flop. Let the 90 to 180-day lockup expire so the artificial supply constraint is totally removed.
Yeah.
Wait 6 to 12 months so the company is forced to run the gauntlet of a few actual quarterly earnings reports.
Give them time to prove it.
Exactly. That is how you allow for true price discovery. And on a macro level, watch the aggregate volume. When a flood of unprofitable cash-burning companies suddenly starts hitting the public markets, it is a structural signal to reduce your leverage, increase your cash position, and upgrade the quality of your portfolio holdings.
Because understanding the psychology behind the winner's curse, tracking the gray market premiums, and respecting those lockup expirations, that gives you a distinct structural edge over the retail crowd that just, blindly buys the narrative.
It really does. So let's do a quick recap of the journey we just took.
Let's do it.
We started with the dashboard flashing extreme overvaluation through the Buffett indicator and the Schiller KPE. We challenged that with Eisman's reality check, weighing phenomenal corporate earnings against a deteriorating consumer and a 10-year yield crossing the dangerous 4.5% Rubicon.
Right.
We looked back through a century of history, from 1929 investment trusts to 2021 SPACs, to see how insiders use public exuberance as exit liquidity.
Always the same playbook.
Yep. And finally, we looked beneath the surface of today's market to find the hidden leverage trapped behind the private credit refinancing wall.
And by breaking down the underlying causality rather than just reacting to the daily headlines, you can actually read the true temperature of the market.
But I want to leave you with one final provocative thought to mull over, and this was inspired by a single line buried deep in our IPO report.
Well, the structural decline.
Yes. The data shows a structural multi-decade decline in the total number of public companies as private markets continue to expand. We talked about the refinancing wall, but think about the long-term implication here.
It's massive.
If the absolute best, most innovative companies stay private longer and longer, capturing all their hypergrowth behind closed doors, and only the exhausted, overvalued, debt-laden companies ever make it to an IPO just so the insiders can cash out,
Yeah.
will the IPO boom indicator even exist in the next decade? Or will retail investors be permanently locked out of the true wealth creation phase of the market, left fighting over the scraps of the winner's curse?
That structural shift is the multi-trillion-dollar question for the next era of finance.
It truly is. Well, thank you so much for joining us on this deep dive. Stay curious, keep your eyes on the mechanics, and we will see you next time.